Today's conversation is really about how do we get investment. So if you look at the investor's mind, that's what's going on all the time. It's a scale trying to balance. What do you think they're trying to balance? So it's two critical things. It's the risk and it's the return. Ultimately, to get into a relationship with an investor, the return has to outweigh the risk. They have to feel that we will make money if we go into this. They don't just say, we like this person enough and wow, we just want to invest in them. No, they have to see that actually we're going to get a good return. So bear that in mind as we go through the rest of the presentation. If we think about the three things that determine the type of financing you can access, it's important to really note these because half the time, I look at about 20 pitches a day, but half the time, it's the wrong person coming to me because they don't know what business they're running, they've got no idea what money they actually need, and so already it's a no from the get-go just because they don't have this right. So there are three things that determine that. Number one is the type of business you're building. Different types of businesses will require different things as they're going along. Number two is the stage at which your business is. There will be investors that prefer to invest earlier on and those that prefer to invest later on. And number third is what you actually need the money for. These three things form a puzzle where, like, if you can set those up right and approach the right investor for what you need, you've got a higher chance of actually getting the money that you need. So let's look at the type of businesses. These are big buckets. Of course, it's not like fixed buckets. Some businesses are flowing in between, and some businesses can grow from one type to another. The first type is the self-employed type of business. So this is where you are like the consultant, or you've got your side hustle, or you're a freelancer where you're actually the one who's doing the work. And if you're sick, you're not making money because you actually have to be doing the work. And so these are great for the people who, the people who say, like, I want to be able to work from anywhere and just do my own thing, or, I want to work from home for the most part and work as and when I want. But they're also limited because, there's only so much time you have on your hands as an individual. And so there's no one business which is wrong or right. It's really just about preference. So that's the first type, the self-employed. The second type is your small business, which is usually maybe your one B&B or your corner shop. These actually create a lot of employment in our economies, but they're also kind of limited in how big they can expand. It could be that you've got one farm and it's a small holding, and you are happy to just do that, and you're not looking at expanding it into anything commercial. Those are the second type of businesses, your small business. The third type is your scalable business. So this is the type of business, if you do set it up, it's able to really expand even up to 100 times. And this can be made possible, one, through distribution. Maybe you're able to distribute through many people. Two, through technology now. You're able to really get into a lot of markets very quickly. The fourth one is your large corporate, which is your MTNs. I guess Ayoba is now in that space as well. The big corporates that are stable, that have raised money, and they're really now just growing at a nice, stable pace. And your last one is your nonprofit. So it's important to note that for each of these, they will have different risk and return profile. So imagine if I'm an investor who has promised my own investors that I'm going to give them back, say, 3 times their money. I'd be more nervous about investing it into the person who's solo, because every time they get on a minibus, I'm like, yo, there goes the $50,000, because if anything happens to them, that's the end of that money, right? And so what you'll be able to access is very much related to the type of business. And a lot of people get it wrong. Like, I've met people who are consulting and they're like, I need investment. And I ask, to do what? To grow my consulting. How? To get more customers. So you're not thinking about the expansion through a team. You're still just thinking about me doing the work and just getting more customers. It's highly risky for an investor who's getting money from elsewhere to be able to invest in that. Maybe an angel investor who's got their own money is happier to just give you something to grow your business, but somebody else who's getting from somebody else, it becomes difficult. So each of those businesses has got different risk appetites. So, question, for the venture capitalist that is getting money from somewhere else, from an institution to invest in you, Which one do you think is their preference? Number 3. Yeah. 3 and 4. So it's 3 and 4. And there are 2 types of investors investing at that level. At the scalable part, it's mostly your venture capital investor. They've gotten money from elsewhere. They've got limited funds. Your typical venture fund in Africa is around $30 million to $50 million, but they have to get a return for that. And so they'll typically want to look at a scalable business because they've got a higher chance of becoming successful if your business can grow up to 100 times. Then there's the next level investor called the private equity investor who doesn't want any of that risk from the scalable business and is only really interested in that corporate business that they know is growing steadily and that they don't have too much risk. They have bigger pockets, which means they've got more money to lose, right? And so for them, it's like, I'm only going to invest in the corporate. And so where you go matters depending on what type of business you have. The second key that unlocks that is the stage at which your business is. You have no idea how many people come with just their idea and say, I need 10 million rands to bring my idea to life. Do you think somebody who's getting money from other people will just give you $10 million to say, like, yeah, take it and go? So for this continent, at least, our ideas mean nothing, really. And there's so many ideas because we've got so many challenges and everybody's waking up with solutions. And what starts to matter more is the more traction, the more you've done, you start to create this evidence of, yeah, I think this is the person to back. And so each of these stages will have different people that can back you. Really, at that beginning setup stage, it's your personal funds, it's your family and friends because they love you, and you might be able to get an overdraft from your bank, maybe if they've seen that you used to earn some money. At stage 2, this is now when you are actually starting up. So you've got a product and you've started to make some good sales. You might then be able to access, like your angel investors and stuff like that who are like, yeah, I like where this thing is going. Again, there, you can get a loan from your bank maybe when they start to see that you're actually making some money. And for a lot of people, accelerators and incubators have become a really good source of getting just that first check that helps you really put your setup together. And also the corporates. So please don't feel shy to go to a corporate and say that I've got this product which I really feel can benefit your business, and are you able to invest in me? A lot of them have got so much money that they now want to see, like, how do we expand without disrupting what's working? And most of them just want to buy up these businesses. And so they might say, let's do a proof of concept. Here's some money. Let's see how it goes, and then we'll invest more as we're going. I'm sure you've heard in the last 2-3 years how many startups Pick and Pay has bought, for example. And so these corporates have got so much cash now that they're like, well, let's buy any of these innovative things that we feel can really help our businesses to grow. When you've figured out who your customer is and you started growing your business, the third stage is the scaling up. So now you know who your customer is, you know what it is that they want, and now you've got a plan to really grow it. Here you start to access some deeper pockets. You get still angel investors, but here is where you get venture capital. And this is the point where actually a corporate can buy you. A lot of these companies are called managed companies because the corporate has actually bought them and they work within the corporate, but as a separate body. And so there's lots of opportunity there to look outside of just venture capital to get financing from elsewhere. The third stage is where you're really in that growth phase. You've expanded now, and now you're starting to grow steadily. This is where we start to see the big corporates now at the beginning of their stages. And so here again, you might find some VCs there, but you get a lot of private equity money that's coming in now, and still a lot of corporates are able to just do some stuff in that space, depending on the pockets. And the final stage is at maturity. You're big now, and now really nobody can even afford to lend you money, and so you can list on the stock exchange. This is where you start. Yeah, is that your aim? Is that the wish? You can list on the stock exchange, you can merge with another business and become, a bigger business. We've seen a lot of these where you see that Facebook buys Instagram, for example. And so that's that stage where they've expanded so much that now they start to merge to become even bigger, more effective bodies. And so this is an exciting space for companies to get to. And so there's also grants. Grant funding is available mostly for businesses from the startup to the scale-up phase. You don't get grants when you're in the growth phase. And these are available sometimes from government, sometimes from competitions that you can enter. But the best source of financing is always sales. It's the cheapest, and it's the number one thing that shows you that you've actually got a business that can sustain itself ultimately. And so if at any point you can generate sales, there are 1,000 billion-dollar companies that have grown organically through their own sales. So it is possible, and it's important to note that you don't always have to get external funding. You can grow on your own steam if your product is good. And so sales is still the number one skill. Again, each stage will have a different risk and return profile, and that's why you will have different investors playing at the different stage. You remember, private equity has big pockets, so they can't take too much risk, so they only choose growth. Venture capital has got a lot more risk appetite, so they will choose startup and and scale up and so forth. So if you are at that setting up phase and you go straight to private equity, of course they're going to say no. They're like, you're nowhere near what we invest in because you're too risky and you're too small. And so knowing where you are as a business becomes critical, because then you can approach the right investor for your needs. The last piece of that jigsaw is, what do you actually need the money for? A lot of people have gotten into bad financial trouble by matching the wrong money to the wrong thing. And so sometimes all you need is working capital. Yeah. Sometimes all you need is working capital. Working capital is that money that you need to just buffer you through a period. Maybe you've sold your product to, say, a retailer, and they say, we're only paying you in 90 days. Meanwhile, you've got to pay yourself and you've got to pay your employees every month. And you're like, what the heck am I going to do as I wait for the 90 days to come? And so working capital helps you fill those gaps. And so for that type of thing, you don't want to then go to a venture capitalist and say, I need money because I've got these gaps in my business. It takes too long to close a deal with venture capital. Your business will die. So for something like a working capital need, which is short term, you want to look for short-term financing. And some of the options are just get an overdraft, get order financing if you need to finance an order. Get your invoices discounted where somebody pays you in advance and they wait for the invoice. There's shorter term solutions that you can go to do that. Because one, they'll be faster to get the money. And two, you can pay them off quickly, which means you're not stuck with something for a long term when all you needed was money to buffer you for 3 months. Okay. Many people have gotten in trouble here getting a long-term loan when they only needed money for 3 months. So it depends on what you need the money for. The second piece is, for a lot of businesses, they want to buy an asset, or they want to buy property, or they want to extend property. Again, it's not entirely necessary to go to a venture capital person and say, invest in my business because I want to do this. There are faster, easier things that you can do. You can apply for a mortgage, you can get an asset loan, you can get a long-term debt where you actually know how long it will take you to pay for this thing and get out of it quickly. Every type of money costs money. Every type of money costs money. And so with venture capital, for example, it will cost you part of your business. They will be owners in your business and they'll be part of pushing your business with you. With a loan, a lot of times you're going to have some collateral that you've dedicated, and you're going to pay interest on a monthly. Even grants cost money, by the way. I got a grant from a foundation. I can't mention the name. From a foundation, and they expect me to report on impact for 6 years after the grant. So even that costs money because it's an administrative thing. You have to keep reporting, what is your impact? What is your impact of this money? That was used a couple of years ago, right? So every kind of money costs money. And so you might say, okay, I'm at this place and I just want to scale my business now. I know who my customer is. I want to get into new markets. I want to build technology on top of it. And I just want to scale it. I know what I'm doing. That's the place where you can now go to your more equity investors, because they can even help you beyond money. They can help you maybe with contacts. They can help you with unlocking the markets that you want to get into and provide a lot of additional support than if you just get a loan. And so being able to match the right thing with the right type of finance is critical. It saves you problems upfront, but it also ensures that you can lever the right type of support around you. If you need a short-term loan, you don't need anybody telling you what to do in your business. So don't get an equity investor then. Just go and get an overdraft. Finally, for all of the above, sales, again, I can't really emphasize that more. The more you can sell and the more you can get organic growth, the better and healthier your business can actually be. And so I'm not the type of investor that pushes people to say, get funding, get funding, get funding. No, sell, sell, sell is actually more the right route for everyone. So on the types and sources, I get this question a lot, but where can I get the working capital finance? For working capital, go to the bank, get an overdraft. There's micro-lending companies that just give you really quick money and it might be expensive, but you know that you'll pay it off in 3 months. And so it's a faster, easier route to go. And there's working capital providers, the likes of Lelemba, the likes of Vodalend that you can go to and put in your bank statements and they can give you the money in 24 hours, for example. It's not cheap money, but you at least know that in 90 days I'll be out of it. For asset or property financing, there's banks, there's asset financiers who will say, if anything happens, I'll come and pick up my car, for example. So there's asset financiers who can support you. There's also long-term debt financiers who are happy to give you a loan for 10 years, depending on what your business looks like. For equity financing, go to accelerators, go to angel investors, go to venture capital, go to private equity, depending on the stage of your business. And some of the clever businesses that we've actually invested in used all these routes to work their way up to the right type of financing. And it's also, so you also must know that you're not limited to just one. You can mix and match different things. There's revenue-based financing where they say, we actually don't want equity in your business, but what we'll do is for all of your future sales, we'll be getting a percentage until we get maybe 3 times our money back. That's a nice middle point between a loan and equity. Finally, there's your typical debt financing where they say we actually want collateral. This is difficult for lots of small businesses, and it's particularly difficult for women to access because they might not have any property in their names. But if you've got property, your uncle left you, a house, grandmother was rich, you can actually then access debt because you've actually got an asset to put down. And the last one is grants. Grants are an interesting one because you don't even have to go through, for example, the laborious government process of applying for a grant. You can enter competitions. There are a lot of competitions that actually are out there. Nedbank is doing one right now, a pitch and something competition where you can win up to R1 million. And so these competitions are such a good way to just actually boost some of your money up front because you win and they kind of like give you 2 mentors to support you, but they mostly just let you run your business. What they're trying to do is contribute back to their customers a lot of times. I'm sure you've heard like even the radio stations like win 25,000 rands plus this much in marketing. That type of thing can really help unlock your business because you get free publicity on top of the money that they give you. And so look out for those. They're actually way easier than government grants. And you also have development finance institutions that will do things maybe linked to a particular thing, like is it a gender thing that you're doing or a climate thing, and they will give you a grant based on that. The thing about debt is that there's good debt and there's bad debt. Yeah. So try and only get the debt that will make you money and not the debt where you just consume, okay? You'll be paying for clothes that you wore last Christmas. You'll be paying for it for 2 years. Try and avoid that type of debt. And finally, how do you best position yourself to win? I think the most important thing to note is that the relationship with an investor or any financer typically runs about 7 years. Do you know that that's the length of the typical marriage in America? On average, a typical marriage in America lasts for 7 years. And so when you are thinking about getting into this relationship with any financer, know that this relationship is probably going to run over the course of 7 years. Even your bank, how many of you just switch banks easily? You've probably been with the same bank for years. It's a little bit of a marriage. And so think about it as a courtship. Is like, how do we get to know each other? And it's not just about the investor knowing you. It's also about you knowing the investor. You should ask questions. How much is the interest? Don't get surprised 2 months later when they come to pick up your personal stuff. How much is the interest? How much money are you expecting me to pay back? When do I start paying back? If you hear any stories of other people they've invested in, go and ask them, what has your relationship been like? You don't want to be laid with somebody for 7 years who's just horrible and really runs your business to the ground. Because this has happened. This is not an easy relationship. And so when you're getting into it, bear in mind that it really is a courtship. And so, when you are in a courtship, your actions will always speak louder than your words, right? Who's dated before? How does it feel when somebody says, I love you, and they don't act like it? Do you believe it? You get pissed off? And so if you think about this as a relationship, you know that even for an investor, when you say, this is a fantastic business, and you've done nothing, they also get pissed off. They're like, you're taking me for a fool. Ultimately, traction. What have you actually done that you can show me? On your first date, you're not going to completely just say from the get-go, I don't like cooking, I don't like cleaning, I don't like what. You want to put the best things forward, right? You want to say things like, maybe you say, if he likes ambitious girls, you're like, I'm really ambitious. That was me. That was me when we were courting. I'm really ambitious. I'm not really about this get married quick thing, this Insta life. I want to do my career, But it's more about just not saying it, but actually doing it. And so your traction will always speak louder than words. That was my traction, me graduating, taking my boyfriend then to my graduation, showing him that I'm really, into progressing myself. Remember, it's a courtship. Put your best foot forward. And so the things that you can put forward is, what are your monthly sales? Know those things off the back of your mind, because those are the things that show evidence that you are actually doing something and you're building something. How many customers do you have? These are just examples of how to show your traction. How many customers do you actually have? Do you have letters of intent? How many people have you supplied before? All of that thing matters. Do you have a team? So that we know up front if it's just you and we are, risking money, or there are other people who are supporting you, which shows that you've got an ability to convince other people to come on board, which means you've got an ability to sell, particularly if it's early in the days. And so your traction. Keep those numbers up front so that when you're presenting yourself, you're already putting your best foot forward. The second piece about putting your best foot forward is learning how to pitch succinctly. Succinctly means short, concise, to the point. So all of you must practice the ability to say what your business does and how well it's doing just within a minute. Because sometimes that's all you get in a networking context. Somebody's about to run off and they say, oh yeah, this is a great entrepreneur. Just be able to say what you do in a minute and practice. Right? Secondly is build a pitch deck. So have your 1 minute pitch and then develop a concise pitch deck. A pitch deck is a 10-pager maximum where you talk about pieces of your business together. I'm not going to go into that, but I'm going to give you a link that you can access to be able to download a template and be able to really think through your business and write it in a brief, succinct way. A pitch deck is super important because it also helps you really think clearer about your business when you can think about it piece by piece. There's nothing worse than a 30-page business plan. Upfront, nobody has got time for it. You love your business, and so you can take your 30 hours to write that plan, but nobody actually has got time to read it. And so if you can put together a pitch deck, it's so much lighter to consume, and it helps you get to the clear things about what your business is. It's easier for people to digest. And mostly the pitch deck will come after you've told me what your business does in a minute. I'm like, wow, that sounds amazing. I would like to learn more. And then you can share your pitch deck with me. And I'm like, wow, this is really interesting. Then you have deeper conversations. It's courtship. You can't start from day one. Me, what I demand is I want a guy with a car, and I want this. I want a big house. I want to have 20 kids. You can't start like that from day one. How about just, hello, these are my interests, as step one. And so learning to communicate in a way that is digestible but that is clear is super important. Lots of people just get the door shut down because sometimes I've opened my LinkedIn inbox and I scroll 7 times and this message is still going. Like I just do this, I'm like, oh my God, this message is still going. It's difficult. Like nobody even has that attention span anymore with how much we scroll on social media. People have got this much attention span. So how do you communicate very succinctly? Third, again, know your key metrics. Those are so important. Sales. Put that up front. This is how much sales we have. This is how many customers we have. In your nice little message, put that up front. Have a nice little overview for your pitch. That way, people can already see that this person is already creating traction and they know what is important in their business. Sometimes we're obsessed with the technology. Oh, my tech is so good, and yet we don't even know how many people are using it or if they even need it. Sometimes we're just obsessed with the problem and we don't even know the problem we're solving. We're like, I'm solving unemployment. That's the big problem to solve. So it's more about how do you show that the thing that you have is actually wanted by people by emphasizing on the right things. And lastly, keep your business records. It's boring to have accounts, yes. Boring. Get an accountant, get a bookkeeper, honestly. Angela is here. Angela is here up front. Having records helps to reduce the time for knowing each other, right? That's what the investor wants quickly. How do I know you quickly? I'll tell you that the fastest we've invested, which is like a record in venture capital in an entrepreneur, is from hello to investment in 6 weeks. But she had everything. Do you have your accounts? Here you go. Tax compliance, yes, here it is. Your employee structure, here it is. She just had everything. And it felt on some days like the minute I press send, the reply is already back. But because she kept everything at hand. And this just shortens how quickly we get to know each other, right? And so, again, it's a courtship. So when you're in a courtship, what you want to do is you're spending as much time together so that you know each other, so that you can eliminate as much risk as possible. And the records help us do that. So some of the key things that you should actually have at hand is, number one, just some management accounts. They don't have to be audited. You just want to know you are actually taking some accounts and you know what's happening in your business. That's where we'll see your sales numbers, ultimately. You can tell us how much you're selling, but if it's not showing in your accounts, it's still a different thing. So management accounts. Number two, just some bank statements. It shows us how much money is going in and how much money is going out. Even if you are applying for a bond, that's the first thing they're looking at. That's why it's really easier to get your bond from your banker than another banker, because they can already see the record. So this just helps us shorten the amount of time. Number three is really tax compliance. Tax compliance is a character thing. If your taxes are not up to date, it says a lot. If you're trying to dodge things, what else are you going to try and dodge? And so just tax compliance. It's simple, it's quick, particularly if you're already doing your management accounts, it's an easy one to keep. Ultimately, what we want to do is just shorten the time from courtship to marriage, right? That took us 10 months, by the way, from courtship to marriage. And you know why? He lived in the flat underneath my flat, so there was a lot of due diligence checking. Due diligence was fast-tracked today. That's what records help you do, fast-track the due diligence, so that everybody is comfortable on both sides. And so it's doable when you know how to place the pieces of the puzzle together, and there is money looking for a place to grow. And the only thing that the investor or any financer wants to know is that when they put it in you, it will actually grow. So good luck and all the best with that journey. Thank you.